My name is John Jacobs. I'm here with the Center for Financial Markets and Policy here at Georgetown University. Delighted that you all could join us. Delighted with my panelists here. It should be a very interesting one, although I'd see none of us are wearing the socks that Tom Whitman wore, so we'll have to change that for next year, get some branding for our socks. So let me introduce our panelists real quick. This topic is, we're talking about trends in the capital markets and innovation. I'm going to introduce our panelists just by name and title and organization, and then I'll let each of them speak a moment or two about who they are, what they do, and what their organizations do. And then we'll start with the questions. And as we do with every one of our panels, we will definitely set aside some time for audience questions at the end. So make sure you get ready for those questions. To my immediate left is Nelson Griggs. He's the Executive Vice President at Nasdaq and also President of the Nasdaq Stock Exchange. He and I worked together for many years at Nasdaq. He doesn't tell people that. I do, but he doesn't tell people that. But followed up next by Ari Rubenstein, the CEO and founder of GTS. Bob Walley, the co-head of global securities at Deloitte. Mike Beller, CEO of Thesys, that came up a little bit at the last panel. And then Daniel Gorfine, CIO at the CFTC. So Nelson, why don't we start with you?
Great. Thanks, John. Great to be here today. And by way of background, I run Nasdaq's primary business is a listing business at Nasdaq. So that consists of about 2,700 companies in the U.S., also another 800 or so with our Nordic offering. And my team works on companies that are already public, but also pre-public companies. And we have a pretty big initiative now, last 3 years, on the Nasdaq private market. So that's also under my watch. And a handful of other things, but that's the main role.
Great, welcome. Thank you.
Thanks, John. Yeah. Pleasure to be here as well. I'm Ari Rubenstein. I'm one of the co-founders, and I'm the CEO of GTS. GTS is an electronic market maker, which means we provide offers to buy and sell thousands of different financial instruments electronically across global markets. And we do this quantitatively using computers. And almost all of our trading is entirely automated. In the U.S. cash equity markets, on any given day, we might be 3 or 5% of the consolidated volumes in those markets. And we're also the largest designated market maker at the New York Stock Exchange, which means that we're responsible and directly accountable to over 900 public companies and their investors to make sure that there's ample liquidity available in those shares when investors need to access it.
Great, thank you.
Good. Good morning. Pleasure to be here. Bob Walley, principal in Deloitte's advisory business. I lead our securities practice, helping broker-dealers, buy-side, sell-side, implement regulation, change, compliance. Grew up in exchanges on the regulatory side, have a lot of experience in bringing to bear really sustainable operational integrity. Have had the pleasure of working with the exchanges for the last 5 years on the consolidated audit trail. My team also helped write the industry playbook for T+2 that just went in for the industry.
My name is Mike Beller. I'm the CEO of Thesys Technologies. Thesys was founded in 2009. It grew out of TradeWorks, which was a trading firm, and it was founded in order to turn sort of the cost of building trading technology for a trading firm into a profit center. And so we've built up trading platform technology, matching engine technology, for the likes of Bank of America, for Level ATS. We touch about 6% of US equities every day. And in 2013, we built and delivered the cloud-based MIDAS systems to the Securities and Exchange Commission for analyzing market data. In 2017, we were selected to build and run the consolidated audit trail, which will be the largest financial database in the world, very important to US regulation and competitiveness. We created a subsidiary called Thesys Cat LLC to perform that role.
Great, and I'm Daniel Gorfine. I'm Director of Lab CFTC and the Chief Innovation Officer at the agency. I'll just briefly share with you how I came to the fintech and innovation space, especially because I'm a lawyer by background, and you don't normally hear lawyer and innovation together. So I began my career in private practice at a law firm in Washington, D.C., but then in 2011 had the opportunity to join a think tank where I was doing financial market policy work. And one of the areas that we focused on and that kind of caught our attention early on, which you heard about on the last panel, was the Jobs Act legislation, which also included provisions around things like equity crowdfunding and online accredited investor portals and things like Reg A+, the mini IPO exemption. And when we stepped back and looked at that and thought, what are the common threads and themes there, we identified kind of the role of the internet and technology and financial services and markets and started doing some policy work around that. From there, I had an opportunity to be at a fintech company that went public in 2014. It was the New York Stock Exchange. I'm not sure if I should actually say that now on this panel, given the last one. And then just 3 months ago, I had the opportunity to join the CFTC and execute on the vision that our chairman, Chris Giancarlo, has stated, which is to convert kind of the agency into a true 21st century regulator, make sure that we are able to keep pace with increasingly digital markets. And I'll talk more as we go about the initiative.
Great, thank you, and thanks all of you. So you can tell we have a very diverse panel here, with lots of different things to talk about. I was going to kick it off by asking about the IPO process, but I think the last panel pretty much wiped that.
I was going to say, Tom stole all my talking points.
I think he did, but I do want to attack that problem from maybe a slightly different angle, and maybe we'll start with Ari, with you, and then maybe Nelson, and then go from there. But let's talk about liquidity for small and mid-cap companies. I talked about more the capital raising side, but let's talk about the liquidity for those companies.
Look, I mean, I don't think I just speak for myself and GTS by saying that, we want to keep America number one in capital markets and finance. And you do that by making sure that the secondary markets are fertile ground for companies that are private to want to go public, especially small and mid-cap growth companies, as well as companies that are public to stay public. When we talk to companies, they tell us that they want two things in their secondary market. The first thing is that they want their listed exchange to have a tremendous amount of liquidity available for investors. From GTS's perspective, we're market makers in a lot of different instruments, foreign currencies, derivatives, cash equities. When we look at the US cash equity markets, though, there is a relationship between market maker obligations and market quality on that particular market. It's inversely related. If you have higher market making obligations, there's better market quality metrics. And I'd like to point out that on the New York Stock Exchange, which has the strictest market maker rules for their designated market makers, where they have to not just have a quoting requirement in each security, but we have to file a capital commitment schedule for each security that we're a designated market maker in. So in some ways, we have to be the buyer of last resort if the stock goes down and provide liquidity if there's huge demand. So, but it's no surprise that if you look at that, there's more liquidity at the best bid and offer in New York compared to other markets. There's a larger amount of liquidity available, just in size. And the difference between the bid-ask spread, which a lot of folks count towards investment costs, is lower there. So I think we can drive more liquidity, certainly in small and mid-cap securities, by having stricter market maker obligations. And the second thing that companies are telling us is they want their listed exchange to conduct their closing auction. The close right now is growing. And by some measures, it represents over 5% of all the volume that trades. And it's really the report card of the capital markets. You look in the newspaper the next day, or you open the envelope of your portfolio, and it's marked to the close. And public companies and private ones thinking of going public don't want that closing process fractured amongst Wall Street intermediaries. So I think in trying to promote a healthier secondary market, we ought to listen to what the companies are saying, and that's what they're telling us.
Nelson, would you like to weigh in?
We can agree to disagree on market quality statistics, I think, with the time we have on the panel.
Right.
Yeah, I would say that when I meet with companies all the time of all ranges of sizes. I think Ari made some great points that the headline names in the paper are not the ones we're really concerned about today or talking about. It is the large number of community banks. It's a lot of stocks, so we're talking about trading 10,000, 50,000 shares a day. I would agree they would like to see some consolidated volume, and that's part of the suspension of UTP plan that the Treasury discussed on Friday. But they're also, I think, more concerned as opposed to maybe the closing cross. It's about, can I get research coverage? can I get an audience when I go out for non-deal roadshows? Those are the things, that part of the industry is what has kind of died and is dying, where when you have zero analyst coverage, one analyst covering you, it makes it very hard to generate that liquidity. Right. So I think there's, and this has been a long-term 10-year debate here, maybe longer than that, but that's probably has not had enough thoughtful consideration from the entire industry to say, what do we do for these companies and how we support them to get that kind of attention. I think that drives liquidity as much as maybe the market structure.
And that whole idea reinforces that it's so hard to be a small public company today.
It is, because do you have IR staff? Do you outsource it? How do you structure your communication with investors? And the cost that we were talking about in the last panel from the regulatory framework, for a small company, that can be hundreds, $200,000 a year, which are bodies they can't have to support that type of infrastructure. So I think the regulatory aspect was talked about in the last panel is real important. The market structure component is very important, but the bigger piece that I think, or not a bigger piece, but equally as important is how do you address the lack of coverage and lack of interest in these names is something that we have to really spend some time on.
Absolutely. I think, and Jim Angel, I think in his panel will later on address this issue, similar to how small and new ETFs and ETPs are liquidity, seed capital, all those things. So if he wasn't, he's going to cover it now because he's right here in the front row.
I knew Jim would have the answers. That's good to know.
His office door is 2 doors down from mine. We did talk about this. So let me flip over to a different topic and grab Bob and Mike on this. So because Bob, you said that it was a pleasure working at the exchanges for 5 years on the CAT. And I was like, and he said it with a straight face. So okay. There was a lot of discussion last time. There's a lot of discussion recently at STA on CAT. It's coming very soon. So, and I think I've seen some of the comments now resonating around the security issue. So why don't you, either one of you can jump in first and talk, but let's give us an update, your view on the CAT, where we are, where we're going, and talk about with the concerns you just heard about from the exchanges.
Mike, I'll start out because I think a little bit of history. I think we just finished 5 years, a little over 5 years on the consolidated audit trail, working with all of the U.S. exchanges. So there's been 21 participants, including FINRA, this entire process. We've had over 1,300 conference calls over the 5 years, developing the RFP, reviewing bids, understanding who the plan processors are going to be, the development of the NMS plan, in very, very thoughtful, meaningful way. I would say over those 1,300 phone calls, on average, we have 30 to 50 individuals on those calls. We have had probably 90% of representation of every exchange on those calls. So they've been very thoughtful about, sort of going through the process, developing, especially the NMS plan and working with the SEC. The thoughtful process that's gone into the selection of Thesys as the plan processor, development of the plan processor agreement, the requirements for CAT. I will tell you, since day one and sort of helping craft the RFP through where we are today, security has absolutely been the #1 priority, and we've known how sensitive it is. One of the reasons why Thesys was selected was truly because of sort of security being built into their DNA, into their infrastructure. But it has not, gone unnoticed, sort of the incidents that have happened, around the world, and candidly, a very sensitized topic in the last 3 months, right? Sure. If we roll back 3 months ago, things have been rolling along, certainly always of interest, and it's been of an interest of the industry groups. But I think the fact of the matter is there's work to be done, and absolutely need to protect this asset. But I think, the development process, where we are in the plan, turn it over to you, Mike. Really, it's been a collaborative, constructive process. So everybody's been on this journey for a long time.
Yeah, and I think that I'd like to point out right from the start that I think the consolidated audit trail is very important for the U.S. markets and very important for our competitiveness. I think that to say that we have everything we need when everything we need is essentially a 15-year-old legacy system that has issues with how you report to it and how you use it in surveillance and doesn't have all the information we need. I don't think that's a great way to talk about the CAT. I think the CAT is the next generation. It's a new system with what the regulators need in order to be able to see what's going on in the markets. So I think that what we saw when we started working on Consolidated Audit Trail was that this was going to be a very big and very sensitive database, okay? And we had to think about it in a new way and build in security from the ground up. So security is job one. And while Equifax is a new breach, there have been breaches going on throughout all the years, and nobody was unaware of that in developing the plans for the CAT. So making it secure is job one. But it's more than just having a secure system. It's important to have a system where the regulators can do their work and see all the information in context. And without that, what happens is investigations tend to involve sending letters and waiting, and by the time the information is back, do we even remember does the regulator even remember what they were looking for at that point? I'm sure they do, they have notes, but it's not an efficient way to provide the transparency that we really need in the markets. CAT will provide that transparency, and we're building it with security from the ground up. We're building it with all the tools that the regulators need to do their job, and we're building it to be easy to report to. So over time, I think we will see a change in how the markets are regulated, and it will be for the better, providing a more transparent, more competitive, and more secure market for all of us.
Mike, maybe just to add on to that, I do also think sort of the benefit to the industry. If you think about the attention around electronic blue sheets and OATs, right? OATs has evolved over the years. Blue sheets is this request, a demand as there's an investigation. Candidly, if you sort of compiled all of the fines that the industry has, absorbed, if you will, or been imposed on them, really around sort of the reporting process. So I do think, to your point, Mike, the silver lining in a way is that there is an opportunity to look in the past and say, what were all the challenges around regulatory reporting, around data? We've got all kinds of really interesting new tools to help facilitate this, to really sort of help streamline these processes, have less overhead and less cost. And it's an opportunity, to the fact that it's not OATS 2.0, is an opportunity for the industry.
What's the launch date? Go live?
November 15th.
November 15th. Great. Excellent. I'm going to switch gears a little bit again, and let's talk to Daniel about innovation. So the CFTC has Lab CFTC, which you talked about in your introduction. And when I was reading about this, I was like, this is pretty out there, pretty trailblazing, especially for an organization like the CFTC. So talk to us a little bit about how you guys are looking at innovation in the financial markets.
So yeah, I mean, and that's right. The goal of Lab CFTC is exactly that, to be very forward-looking. And our objective is to facilitate market-enhancing innovation, and at the same time ensure that the regulator can keep pace with what's actually transpiring in the market, so we can identify emerging regulatory opportunities or challenges. And I think, to just step back a little bit, when we think about technology and fintech, there are certain characteristics that seem to kind of demand some of this type of forward thinking and being very proactive. The first thing is, if you just look at the sheer pace of innovation and then the speed of adoption that we're seeing, a lot of that's tied to computing power, and a lot of that is tied to the ways that you deploy new technologies. If you think about certain payment apps that have gone out to market, in a very short period of time, they can scale up and be operating on a national level, facilitating billions of dollars of transactions, whereas historically, a traditional brick and mortar institution might take a decade or more to scale up nationally because they literally needed a physical footprint in every single locale or state that they were going to be operating. So that's something that's different. And the other kind of key characteristic that I would point out is that a lot of these emerging technologies in the fintech space are focused on either changing the way traditional intermediaries operate or even trying to bypass traditional intermediaries. So that poses another interesting set of questions from a regulatory perspective. So what we're trying to do through Lab CFTC, as I said at the outset, is facilitate market-enhancing innovation, but also ensure that we remain proactive. We basically will do this in three primary ways. The first is to engage with innovators. That is a bit of a change in the way that most regulators operate, in that we're proactively seeking to engage with folks who are either true startups out of a garage or established financial institutions or leading technology companies. Anybody who's trying to do something that's innovative in the markets, utilizing technology, we want to hear from them. We want to understand where the market is heading so that, again, we can be forward-looking. If some of this stuff might not change the world tomorrow, but what's the world going to look like 3 to 5 years from now? So that's kind of the first prong. The second thing that we're looking to do is once we identify certain promising technologies, are there certain ones that we should either incorporate as an agency so that we're a more digital, efficient, and agile regulator, or are there things that we can stimulate through things like competitions or hackathons? Then the last prong is really for us to serve as an internal resource for our colleagues, make sure that we can help educate on what's happening in the market, as well as work closely with domestic and international regulators who are thinking about best practices around fintech innovation.
So are you like a central resource for all of CFTC when it comes to innovation?
Yeah, but let me, look, we rely, the way it's set up is it's a very kind of wide setup in that we're only as strong as the support that we're getting from and between all of our colleagues. So we're set up in a way where we actually have what we call a liaison network. So we have senior folks in all of our various divisions and offices within the agency, and we'll rely on their subject matter expertise if there are particular questions or issues that come up that would be relevant to them. So it's kind of a hub and spoke model that then kind of feeds on itself and can help kind of enhance everybody in all the work that we're doing at the agency.
Right. I'm going to ask all of you the same question because every one of you represents a different type and size of organization. So Nelson, it's innovation at Nasdaq. Now it's a $13 billion company with lots of different businesses, global. Is it central? Is it by business unit? So has it changed in 2 years?
Yeah, well, you told me, John. No, it's changing every day. And as you know, Adina Freeman took over as CEO in January. And there's a lot of, the way we look at innovation at Nasdaq is that we are separated into 5 different business units. So in each business unit, we do have our own forms of innovation, but there is also a central technology group that helps us facilitate that. So one example would be, I mentioned in my introduction that about 3 years ago, we started a Nasdaq private market. And as companies have stayed private longer, we are the largest provider of liquidity solutions for leading growth private companies. And we facilitate tender offers where the company may have 1 or 2 large buyers and then thousands of sellers where their employees are selling stock in a private manner. So we operate software that does that. And we started to incorporate, it's a very low velocity market, so it's a great testing ground for technologies like blockchain. Mm-hmm. And so we actually do have a blockchain project that we are live today in production using it with our private facilitation of transactions. And it's evolved where in my group they do work with Audio Labs, and we have a partnership with Citi working on a Citi payment solution leveraging this blockchain technology. So I think what we look at it is in our different business units, we try to find actionable areas to use innovation in areas where it's a kind of a testing ground to see if it's more applicable to a larger, broader NASDAQ. So now that same technology is being used by the market technology team at NASDAQ that sells technology globally with a few of their exchange clients. So it's evolving every day how we do it, but the whole thing for us is try to find actually ways to put it in production to understand how it can be used in low-risk environments. Yeah. And been pretty successful.
Excellent. All right.
Yeah, I mean, the question reminds me of GTS's stated core mission, which is to provide value to the capital markets ecosystem using innovative technology. That's our simple core mission at the firm. And it starts with the culture and having an environment of freedom for clever individuals to research and coming up with different solutions. And it's really in our DNA when we go all the way back. I remember when market access rules went into production late last decade, and we had built one of the first commercial risk management gateways that we essentially just took what we built for ourselves to monitor our own trading activity, and we found that there were a lot of large and scale institutions, mainly some multinational banks who wanted to use it, so we commercialized it. And a few years ago, a bunch of engineers came into my office and said, hey, all this information that's moving under the ground in fiber optics, it can move a lot more efficiently over microwave circuits. So it was a little scary, but we built out a number of microwave networks, and then we found that, hey, this could be broadly used in the industry, not just for GTS, but for exchanges. I think we had a joint venture with Nasdaq, the CME, some of our competitors, and we commercialized that property, and we ended up selling the property to an exchange consortium. So I think it starts with culture and a innate sense that the financial markets are always going to be changing, and technology really drives that change.
So at Deloitte, I think it's sort of a two-sided coin. I think that, first of all, we focus a lot on disruption, a lot on innovation, and I'll just say innovation for developing services for our clients really been there since the 18 years I've been at Deloitte. I think the innovation for Deloitte internally is how do we develop enablement of our services to our clients and reduce our cost of ownership, improve our risk management on top of it. When we're going to our clients, I think it's been extremely interesting, especially in the broker-dealer world, the exchange world, whether it's natural language processing, whether it's robotics, and really there's a whole lot of shiny new toys out there. And I think the challenge is there's a lot of shiny new toys, and I'm not sure everybody knows how to use them. So the question is, are you using the right tools for the right things? I think that there are certainly some low-hanging fruit, but there's certainly a tremendous amount of risk management and understanding that needs to go into it. If you think about what's going on in the world of robotics and bots, we've got a client who's sort of turning on 300 in the next month or so. But what happens when sort of the underlying systems start to change? What happens when these bots compete with one another? So it's not just a matter of turning on all this technology, but you need to do it in a very thoughtful way to use the right tools for the right things, but also that they have operational integrity, that they're fulfilling the rules and regulations and needs of the organization. And don't forget, a bot still needs to be supervised. It's just like a person, just because it can sit in a dark room and operate all night. So there's certainly some low-hanging fruit, some opportunities. I think those will get swooped up pretty quick. The question will be, what's that next evolution of these things? Natural language processing, AI, machine learning, tremendous opportunities. But again, if you you got to be pretty selective on what you're focused on. And I think the last panel, Chris had made the comment, what's the problem we're trying to solve? And if we don't forget the what, the how, the why is really important, and the how sort of makes it important. But if we don't know the problem we're trying to solve and focus on the what, some of those other things don't make a difference.
At Thesys, our mission is better markets through technology. And what we mean by that is we see ways in which, over the years, technology continues to improve the quality of our markets and the transparency of our markets, and we want to be a part of that process. The way we do that is through something we call market structure technology. Market structure technology is really about taking the capital markets and bringing them into the new age of cloud and big data technology and high-performance trading technology. These are all areas that we touch in our businesses, in our trading platform, which touches 6% of the U.S. equities, in the Midas system, in consolidated audit trail. What we're doing is essentially addressing a problem that's occurred. There's been an enormous increase in the amount of data that's necessary to do a really good job, both in trading and in monitoring trading. But not everybody's information systems have kept up with it. And the off-the-shelf big data technology that Silicon Valley has provided really was not designed for our industry. It was designed, does a great job at web retail. If you want to go build a web retail store, you can go to a cloud provider and you can just put whatever your catalog is there. You can use their payment system, you can use their cloud, and you can scale to millions of customers in days. But every time we go to build capital market systems, we have to get front office systems, middle office systems, back office systems, and then we spend 10 times more gluing them together than we did to buy them in the first place. And it's not because, there's all kinds of reasons for this, but one of which is really just that a lot of the advances in off-the-shelf and open source technology just hasn't been targeted to our industry. So at Thesys, we have essentially built versions of those technologies that all work together, okay, and solve the additional issues like security and compliance that allow capital markets applications to use modern technology to move into the cloud. And that is where we're headed. And so we're all about innovation. And innovation isn't just invention. Innovation is inventing and then achieving some positive good through the adoption of that invention. That's who we are.
So it's interesting that all five of you used innovation and used technology to talk about innovation, and which is not surprising, but it's just part and parcel to anything in every area of financial services, that innovation is largely, not completely, but largely based on technology and helping, solve problems, drive, solutions, and so on and so forth. Another big thing that comes up, though, and Mike, you touched on it, so I want to go back around, is talk about big data. It came up a little bit last time at the end of the last panel, but big data and how you guys look at big data, how your organizations look at big data. Is it an opportunity? Is it a cross you have to bear? What is, or both or whatever? So we can start. Ari, why don't we start with you on big data?
Sure. I mentioned earlier that we're a DMM at the New York Stock Exchange, and this is a property that we bought from Barclays Bank about a year and a half ago. So part of our job is to explain to public companies what's driving price discovery in their security. And that's a complicated question and a really important question to answer. So what we started to do was realize that all of this data that we analyze to parameterize these trading algorithms that provide liquidity in these securities, we could refashion some of that data and provide some of that information to these public companies. And they're starving for this information. And this is brand new, and we were really impressed by how much valuable content we were just sitting on that could be refashioned and delivered in a unique way that can help a public company navigate the capital markets in different ways, explain to their shareholders, internally, externally, in lots of different ways. So that's one way that we've recently discovered that we could reuse some of this information.
Nelson, how about Nasdaq?
Yeah, so I think to Ari's point, I think a CFO or IRO wants to know what's happening to their stock for two reasons. One, when they run into the CEO in the men's room and wants to know why is my stock dropping up and down the boardroom calls,
Yep.
And they have to have that answer. That's most
Or
common.
the ladies' room.
Answer, ladies' room. Doesn't matter where it is. But that comes up the most is how do I answer this question for the board today, now? But really the better question is, my CEO spends 10 or 15% of my time talking to investors. My CFO 30% of my time. Am I talking to the right people?
Right.
So one of Nasdaq business lines is what's called corporate solutions. We have about 18,000 global clients that we support on IR, outreach, communication, et cetera. And that amasses an incredible amount of data. So if you think about, we track all the meetings in our CRM tool that companies go out and talk to investors. We know who they're talking to. We have an advisory business that talks to companies about what's happening to their stock. So there's a lot of applicability to big data there, or using machine intelligence, machine learning to help the end user, the IRO, the CFO, the CEO determine where's my time best spent. Am I talking to a customer here, meaning an investor that could buy my stock? And so that's what we're focused on a lot is putting that in a very deliverable, easy to use fashion where companies can get the most out of their time. And it's very applicable to the large size companies, but I mentioned before the challenge of small size companies that don't have the big IR budgets. If we can use technology to deliver a more effective delivery mechanism for understanding their shareholder base at a much lower cost, that's really what one of our driving goals are right now.
Daniel?
Yeah, data is such an interesting topic because as I think about this, it's a horizontal disruption, right? It cuts across everything. So it was interesting going around the horn here and talking about some of the technologies that folks are working on, whether it's private, permission ledger systems, distributed ledger systems, or if you're talking about cloud, or you're talking about machine learning. A lot of that is actually predicated on data, cleaning data, standardizing data, and then utilizing data. So, it really is kind of part and parcel, I think, to many of the areas of innovation taking place. It holds a significant amount of promise across all those areas, but what it also highlights, which has also come up, is the role of cybersecurity and data security, because just as much as it can unleash so much good, that means that it becomes higher stakes when you start talking about pools of data, whether they're sitting in a ledger system, cloud, elsewhere, like that. Now that integrity of the data becomes even more paramount.
Absolutely. Mike?
Well, it's funny, this phrase big data, because
I was going to ask everyone to define it because I figured we get 5 different answers, but go ahead.
I have a great definition.
Okay.
The definition is, I think, any amount of data more than your current system can handle. And the reason that ends up being important is because big data is about the change from a world where mostly the people who interacted with computers were clerks who entered information in stores, or perhaps phone representatives who entered information. And that type of information tended to be on the order of one per transaction, okay? Or a handful per clerk per day. Those numbers end up being in the millions or perhaps low billions worldwide. But what we've entered is a world where everybody's connected to a network, and everybody is a source of information, and not just when they've made the decision to pick up a phone and call somebody and ask something, or push a go button on a purchase on the web, but literally every time they click on anything. And that's the transition from the 90s, where we had databases that were designed to handle billions of records at the largest scale, to the 2000s, where they have to handle hundreds of billions and trillions. And now we are entering a world of the Internet of Things, where big data is going to not just be on the scale of every human and their activities, but everything and its activities. Your refrigerator and what it does all day, okay? That means a continued massive increase in the amount of data that we have to be able to handle, and it makes huge changes to the types of processing that we have to do. And that has implications certainly in terms of how we build our systems, but it has implications in terms of how we secure our systems. And the greater interconnectedness only makes that a greater problem. So I think that we're on a ride here that's going to go on for several decades, and it is going to keep people continually having to innovate just in order to keep up with what they really need to be able to do their jobs.
So I'll bring this sort of back to a little bit of focus. We spend a lot of times with our clients with the use of big data technologies, so I sort of use it as a amorphous thing, about enablement. But if I think about surveilling the markets, traditionally we've had very, very siloed systems. One system doesn't talk to another, one group doesn't talk to another. The fact of the matter is, if we think about holistic surveillance and the number of clues that are out there, that the behavioral sciences, we hear about conduct risk, and we heard a little bit earlier about the behavior of individuals, all sort of influences manifests itself in different trading behaviors, different actions. If we think about consolidated audit trail, the ability to discover and understand routes and understand the economics in individual behaviors, but now tie it together to all the unstructured data. And what used to be an impossible task is now enabled by some of these pretty interesting technologies, and sort of lessens that threshold that can I really identify the bad actors and really start to think about moving to to predictive. So I think, as we think about all these technologies, and everybody, your points are very, very valid. I think the fact of the matter is, how do we apply them? How do we control them? How do we actually understand them? Because I think you're going to start to unearth a whole bunch of new behaviors and situations that we haven't seen before. So you're going to have to be answering a lot of questions, and therefore be able to deliver that data and those scenarios back to those users to have an understanding. So, big, broad, but how do we sort of use it? And that's what we're talking to our clients about, in the world of overseeing the markets.
Right. So before we go to audience questions, I always ask, this is my scary question to ask. So, and I'm going to do it in a two-parter. So I'm going to ask you, what keeps you up at night? Or what is, when you wake up in the morning or get woke up in the middle of the night, you get that text message, not family stuff, but, work stuff. You get that text message, that phone call. What is the one thing you dread hearing about right now for immediate? And then what is keeping you awake thinking about 5 years from now? So I'm going to start with you because you're next to me. So what keeps you up at night?
Well, the dreaded call today is anything with systems or security that comes up that affects our clients and our reputation. So although it's not directly in my purview, I'm not the CISO, I don't run technology. We have so many clients that are affected by that on a daily basis that's what you hate to get from a text or an email that says, hey, we got to hop on a call now. And it comes up. I think the beauty right now of the U.S. equity capital markets is they are very interconnected. Right. And when one system does go down, it seems like there's a very good backup in place for it, which you feel like your clients are for the most part protected. But there's obviously reputational risk as a exchange provider that we have to worry about. And I think going out 5 years, it's always. For us, we spent some time on this today, but how do we keep the U.S. capital markets vibrant the leader in the world and do things that are going to really encourage the entrepreneurship that has made this company, what it is today. And there is so many great things we have going for us, but there are areas we do feel, as we've outlined quite a bit, that we need to spend time on. And we all know that even though we do feel there's some wind behind our backs right now, potential movement on this, it takes a long, long time to get policy changes through, regulation changes through, things we feel are important, and administrations change, folks at the SEC change, and can you get this work done in a period of time that is efficient to actually have an impact?
Yeah. By the way, you're reconvening this panel by 5 years at this conference. So we'll see how you did. Just see how you did. So, Ari, talk about it.
Well, operational risk in, an all electronic market that definitely, is up there. But, I was debating whether I was going to jump into the cybersecurity,
Right.
conversation, but it really does. That's the thing that keeps me up at night, because all finance is based on trust, and if there were some sort of cyber event in our markets, all the things that we talk about in little market structure items like maker-taker pricing and speed bumps and all of the different things, they're important. But in perspective to something that could rattle investor confidence, potentially for a whole generation, they're de minimis. And a friend of mine who works with some of the three-letter agencies said there are only, there's two types of people in this world: folks who have been hacked, and folks who think haven't been hacked, but they've been hacked.
Right.
So he was just kidding around. But I think that we need a very sober view of our capabilities, just in general, and be very careful. And now, since I'm on the topic, CAT is a great idea. A great, well-functioning market needs a regulator that has state-of-the-art technology and the ability at a granular level and with high resolution to monitor the activities in the market. But I think the question people are debating now, which is really important, is how far does that go, and how could it go too far and end up being counterproductive? And you talked about raising the stakes as we're all spending a lot of money and time, and all of our, everyone at our firms are working hard to build a lot of value in big data and these technologies. We have to make sure that it doesn't just, get exported. And your boss at the CFTC, Giancarlo, and now Congressman Duffy, are taking a leadership stand on source code and intellectual property. And making sure that it's safeguarded as we fulfill the mission of maintaining fair, orderly markets that are well policed.
In 5 years from now?
In 5 years from now, what?
What's your fear for 5 years from now?
That something happens within that 5-year period.
Okay.
So cyber, I think, sort of what's the next incident to happen is candidly on all levels, right, of my clients, of my firm, and very candidly of myself, right? And I think we all sort of worry about it. We're sort of in this new age where it is top of mind and it's sort of constant. I will say sort of on a very personal level, I also worry about, my team, my firm, my clients. We all sort of been going through a lot in the last few months. And I think that these are things to be thoughtful about. And I think it's this big world of business, but there's a very personal level of protecting and making sure everybody's safe and secure. I do think, though, that always acting and worrying about, is everybody always acting in the best interests of our clients and our firms and doing the right thing? So at a behavioral level, we all own it. And I think the question is, are people owning it?
So my view is that there's a lot of comments about cybersecurity as being the biggest fear, and I think part of this, it's an absolutely legitimate concern. I'm also afraid that we fail to act purely out of fear. So what I mean by that is, I think we need to be very thoughtful about cybersecurity, and what we need to do is stop treating it like an afterthought. And I think that a lot of what we see happening today is we have this increased connectedness. What that means is systems, there's a way to, when you had a small town, basically the number of people that could knock on your door and get in that door was was really small. Now, it seems like anybody at any point in the world can knock on any door. And that means that, the approach of just having a door with a lock on it, which was adequate in the small town, and maybe even they didn't lock the doors back in the day. That's a little while back for many people in the room potentially. But that approach, that simple approach, is not the right one to take anymore. And viewing it as, let's go build this great system that we're going to make money with, and oh yeah, let's worry about the security at some point. That's actually the problem. We need to think about security from the ground up, as Thesys did when it approached the cat. And we can make secure systems that will work in the modern world. Now, I think the negative of the fear around cybersecurity is if it gets used to kill every initiative we make that might involve gathering more data, then society loses out on the benefits that can be attained by having, for example, in this case of CAT, the appropriate level of transparency to really have the regulators able to see what's going on in the markets. There are other risks here, folks, okay? And one of them are state actors that are using our markets to launder money and terrorists who are doing the same thing, okay? And we are denying, if we say that, well, let's not gather any data because it's too risky, then we're denying ourselves the ability to catch those problems, which are also very, very serious problems. That's why I think it's a balance. We have to be extremely thoughtful about cybersecurity, but we shouldn't kill initiatives that are important like the consolidated audit trail because of that fear. What we need to do is just do it right.
Daniel, what keeps you up at night?
Yeah, so I think, mine is kind of the flip side of the same coin, and the coin is that markets are changing, right? So on the concern side it goes back to this idea of proactive versus reactive. If we're not thinking about where markets are going, if we don't understand where markets are going, then we will ultimately be reactive when markets change. And you don't want to wake up 5 years from now and say, wait, this world looks completely different than the rule set that we currently have. That would not be a good outcome. But the flip side is also true, that we now have an opportunity to be forward-looking. Let's make sure that we don't have rules that are inhibiting market-enhancing innovation. Let's make sure we're fostering the good and being mindful and proactive about emerging challenges and risks. But that does require a mindset shift of saying that we are going to try to keep pace. We do want to make sure we fully understand where markets are going and make sure that we maintain competitiveness, that we're able to assist capital formation, risk sharing, all of those things that help make a vibrant economy.
Questions from the audience? Microphones over there? There's a microphone over there?
I wondered what the audience would say about the XBRL rules and the Data Act and the standardization of data being forced by the SEC and the federal government.
XBRL? Anyone want to weigh in?
I know that's part of our Revitalize initiative, is that I think companies feel the XBRL has passed its time a bit in terms of the necessity of it, and it's a cost to companies, and investors aren't really leveraging it the way it was when it was, I think it's, 5-7 years old or so. So I think at this point they decided maybe past its time.
Back to, do they know the problem they were trying to solve?
Right. And this is when, right, look at all the things that I think are being suggested from the Treasury and on down from us, is you add them all up, and it's just each one is not going to change the world, but you can accomplish 5 or 10 of them, then you have a real cost savings company, and XBRL fits in that category.
Yes, sir.
Hi. First, I want to say something to Mr. Gorfine. I want to say, years ago when I was a paralegal, I had gone to CFTC and had to file a complaint, and the commissioner there did a great job. He tried to help me out as best as he could, but it's a great agency. I don't let anybody knock you guys down, right? Now to Mr. Rubenstein. When I was in the Army, I was a tactical satellite microwave systems operator, and low latency is the absolute lowest for that. And it's a great idea to push. When they come out with quantum computing, who knows, maybe that'll be lower, but right, you're spot on. Definitely low latency microwave, that's the way to go. But my question to you is though, I was raised, Black-Scholes, the Erlenbeck process, all these great names and for pricing. I'm just curious, are those pricing models still valid, based on big data and these transference of all the types of rules and regulations? I mean, talking to the previous panel, it's like, wow, am I pricing, if I want to purchase some options on the buy side or selling some options on the sell side, just as an example, my pricing models, are they still valid anymore, or am I behind the times in the 1950s?
Sure. Actually, a lot of the classic pricing models are still extremely relevant. I think what's happened though is there's, in some ways, a commoditization of computing power, which is, in some ways, democratized the ability to apply a model to securities pricing. So before it was, okay, have a good model, right, understand it, right? So in the early days, just understanding that model gave you an edge, gave you alpha in price making, okay? But now a lot of folks know about that, as you mentioned. Then it was, okay, do you have the computing power, the speed, the connectivity, and the management, be able to apply that responsibly to securities pricing? Okay, now a lot of folks have that, and with cloud computing, it's become very inexpensive to apply those things. So the answer is yes, but the edge is not in the model. It's now moving on to the next place, which is not the model, the infrastructure. It's the uniqueness of your data that gives you an edge over your competitor. Because your competitor knows the model, has the infrastructure, but maybe isn't as clever on how they're using data. Sure.
Yes.
Yeah. Thanks for this panel. My name is Li Yang. I just wonder what the consumer can do and how the government oversight committee, or actually it's interrelated. How do they cooperate together with your group or leadership?
So I think that, to answer your question,
My question is not just the hacking of the financial institution like brokerage account or asset, but all the real constitutional rights in all dimensions.
so I think the CAT is a perfect example of 21 exchanges and we're working together to try to build systems to solve problems, et cetera. So I've got 35 years in this industry, and you guys can jump in, but I've never seen a higher level of cooperation, even among competitors, to try to solve problems, because a system issue at one place is today, could be somebody else's tomorrow or something else. So I've never seen the securities industry more unified in protecting investors than ever before. So
I think one of the things that's been interesting, I think, Mike, you were touching upon it, but I think it's really important sort of as an entire sort of topic is we need to get specific. Sort of these glossed over high sort of statements that, I've got all this data, and to your point, Mike, what are we giving up by not having it? The fact of the matter is we need to sort of debunk the myths. Right. And what are the actual concerns, and therefore how are they mitigated and risk managed in a truly operational and effective way? So it's not just sort of, do I get through the fence, but how do I detect it? How do I respond to it? I mean, there are layers of this, and I think as a lot of these conversations get very sort of glossed over, they also take a life of their own, versus we need to debunk the myth and be very specific about what are the concerns and how do we solve for those concerns and build a system that's got the highest integrity and protection.
right. I think we'll end on that note. So please join me in thanking our panel. Great job.